We got to talk about the news that happened today. So every once in a while, the numbers we think that we can trust, they get turned completely upside down. And that's exactly what happened when the Bureau of Labor Statistics dropped a complete bombshell today. Nearly 1 million jobs that we thought were created and added last year never existed. It's like that South Park scene where they deposit some money in their bank and then the guy crunches some numbers real quick on the computer and then he's like, and it's gone. So they never existed, and it's that kind of revision that doesn't just tweak the story of the labor market, it completely rewrites it and our opinions we have about it. So let's get into it. The Bureau of Labor Statistics said that from early 2024 through March of 2025, oh, I'm on the wrong screen, the US actually added 911,000 fewer jobs than first reported. 911, we have an emergency. So that's not really good. That cuts the average monthly pace of hiring nearly in half from where we were, from 147,000 to just about 70,000. By the raw numbers, this is largely the largest preliminary downward revision since back in 2000, and when measured as a percentage of total jobs, it's the worst adjustment since the aftermath of the 2008 crisis. And suddenly the job market we thought was steady, everybody was talking about how resilient it is, all the Federal Reserve members and all those high-end PhD economists, oh, it's doing good, we're not worried about it, not even a little bit. It's starting to look a lot more shaky now that we're getting this kind of stuff coming out. So here's how the revisions work. Let's talk about it. So what happens is each month the jobs report is based on surveys of about 121,000 businesses or so. Now that survey has its blind spots just like everybody does. It misses new firms starting up, and it can't quickly tell whether a company that stops responding has gone out of business. So those are two major blind spots right there. And to fill in those gaps, the BLS uses this model. It's called it's statistical birth-death model. Now that model works, or has worked well in the past, I guess, if that's what you'd consider it. But when conditions shift, like the pandemic or during the recent trade war, the model struggles and really shows the limits that it has. So that's when the annual benchmark revisions come in. Using the unemployment tax records from across the country, the BLS aligns its survey data with the harder numbers. And today's release is just the preliminary round, so we won't get the final revisions, that final number, until about February of 2026. So we're still quite a ways out. But the signal's pretty clear at this point. The labor market this year is far weaker than we realized. And some people were guessing this. It's just, like I said earlier, some of those Fed members and some of those high-end PhD economists, everything's cool. But the timing couldn't be more charged because President Trump has been blasting the BLS for months and is already working on replacing its leadership. Today, the White House said that the revisions prove the economy is way weaker than we thought it was and show why the agency needs new leadership. But then there's these critics that warn that installing a political loyalist who will bow down to Trump could lead to another round of unreliable data. Because think about it. If they're going to juice up these numbers like a lot of people think they are, they're going to suck up to Trump and only show the good in the data. Imagine what we're not even leaving where we're currently at. We're going to see these rounds of revisions once again if they're juicing these numbers, and potentially larger revisions down the road. But I have my own opinion. Maybe they're looking for somebody more accurate and they might change the model or figure out some way to, just predict the numbers a tad bit better than they are right now, because 911,000 revised down fewer. Ugh, oof. But for markets, this just lands a few weeks before the Federal Reserve September meeting. There's this 100% chance of a rate cut that investors are pricing in, with most expecting a quarter point cut, but some are betting on a half point. I'd say unless we just get some terrible inflation data this week, and we'll talk about that here in a sec, a quarter is probably where we're going to fall on that. But the logic is simple. Weaker jobs mean the Fed has cover to ease policy, but there's this catch, and it's that inflation data I just mentioned, which still looms this week. So producer prices hit their biggest jump in 3 years back in July, largely because of tariffs. So if Wednesday's PPI or Thursday's CPI show another round of increase in inflation, the Fed could find itself stuck between a weakening jobs market and rising prices. That's that classic stagflation dilemma that everybody's been wondering if we're going to end up facing or not. Seems like we're in that stagflation light that a lot of the headlines have been saying, but who knows where we go later on into the year when we see that business cycle slow down just heading into the winter. Meanwhile, the Census Bureau said that inflation, and this one was interesting. Let me pull it up for us. So inflation ate away wage gains last year, leaving median household income stuck at about the same level as 2019. And for most companies, most families, that means the recovery never really put them ahead. Only the wealthiest households managed to break away. So it's a tough time for everybody. And then Wall Street had its reaction when Jamie Dimon put it bluntly that the economy is weakening, and then also JP Morgan's trading desk even warned clients that a September rate cut could trigger a sell the news pullback as investors weigh weak macro data against the Fed's moves because it's already priced in. Hedge funds are trimming stock exposure, corporate buybacks have slowed, and even retail investors who have been buying the dip, buy the dip, are finally starting to pull back on that. But overall, despite that news we got, there's still this optimism around the Fed cutting rates. We've seen all three indexes, the Dow, the NASDAQ, the S&P 500, all of those reach a new record high, which in history, that doesn't happen too often. All meanwhile, Bitcoin and bonds, the two Bs, headed down on the day. So here's the real story. The jobs market wasn't nearly as strong as we thought, or at least some of us thought. Inflation risks are still in play, and the Fed is concerned or cornered into cutting rates, and they're trying to play it off as concerned. The question now is whether the rate cuts we're about to see are a sign of strength or a line of defense. I'll let you be the judge of that one. See y'all tomorrow. Have a good